Well, good afternoon, investors. Welcome to the May 7th, just 2 days after Cinco de Mayo edition of Bull Sessions. My name is Mark Robertson. I am joined here by my colleague. We got to get you some adjectives. Tremendous participant and investor, Matt Spielman.
Yeah, I have to work on superlatives. My chest ribbons and medals aren't quite as built up as normal folks in this chair.
We all need more groupies so that we can get those type of accolades to throw in there as we do with Ken. Ken is not able to be with us today. He is on the road. We did capture those pictures on the upper right. There is some speculation that Ken and Natalie snuck over to the Kentucky Derby. And so you can see what they were up to this weekend. We do not have complete confirmation on that, but that has been at least posited. And of course, the Kentucky Derby was this weekend. If you missed it, the closest finish since I believe they said 1947. And in our version, Matt wouldn't let me go to press without putting the Doge dog actually in the leadership position on the slide. So
crypto racing.
The Doge dog by a nose is part of the theme. All right, we are going to talk a little bit about Omaha. I actually watched the meeting for the first time in a few years. Usually Ken and I are somewhere traveling on this weekend, so it was kind of pleasant to watch it. And also the tributes to Charlie were outstanding. And we're gonna do plenty of, as I've dubbed it, the Buffett buffet type stuff. And then we're also going to talk about slight change we made to add the projected return on value, the prove, to your company report pages. Anything else you'd like to add here, Matt?
No, sounds like a good afternoon.
Okay, let's go ahead and see what trouble we can get into. Well, here's the first stop on the trouble tour, Portillo's. Our weekly reminder that Portillo's is not a sponsor of this episode, but they should be. They did report earnings this morning with not quite as much confusion as Air Lease. We might talk about that a little bit, but Portillo's did come in with better earnings, but weaker sales, and the stock price is actually approached $10 a share this morning. And I was tempted. A couple of you have written to me and said that you actually picked up some shares down around that level. And again, I think it's a company with a future. They have some challenges, but again, no endorsement or investment recommendation is intended. I do own some of these shares, so I hope that they behave themselves.
And you had commented, Mark, not to make the whole show about this, that to watch their cash position was something you're concerned about. I did find in their 2023 10K, they own and operate 84 restaurants across 10 states. The only one that is not fully owned is one owned by C&O Chicago, which they own 50% of. So they do not franchise. So okay. They're going to need cash. They're going to need cash to expand.
Well, and then the other way to look at it is if those properties continue to be good from a commerce standpoint, they have inherent value. So they've got some assets.
Yep.
But not cash. So yeah, I'm concerned about the relatively low cash levels, and they are actively expanding, opening a new store in the Surprise, Arizona area, which Matt, you said that's a suburb of Phoenix.
Yep.
And that's fairly recent, I think. Probably in this quarter. But a number of our favorites, the Genpact reference down at the bottom is just a reminder that we are going to cover within the next couple of weeks the entire consulting industry. And this Genpact keeps showing up as a fairly interesting study. Ken Kavola is hosting, as a member of the Mid-Michigan Model Club, a challenge to cognizant technology, which will include Genpact and a number of other firms in the consulting arena. And I'm pretty sure that that's in early June. You'll hear more about it between now and then. I did have the date written down here, but I have misplaced it. It's on June 17th at 6 p.m. And you can find information about the Mid-Michigan. It's a Mid-Michigan Model Club. It's been around for quite some time. They have a fantastic track record, and at least 20, if not 20 5 or so partners in the club with some formidable investing experience. Matt, you weren't a part of that club, were you, in this area?
No, I attended a couple of their meetings, but I was never a member. I was a member of BI Baker.
Okay. All right. So that's something to look forward to. And again, we'll be spending some time between now and then. I also wanted to defer some of the consulting stuff because it is in issue 2 of the Value Line Standard Edition. So we will be updating those as part of our normal process over the next week. All right. No investment recommendation is intended. This is an educational demonstration. In a nutshell, we are simply sharing some time-honored, successful methods that have led to successful investing by a number of us here, whether in our individual portfolios or as partners in investment clubs. So everything is for illustration and demonstration. We're simply trying to show how this community basically stands back and looks at an opportunity and how they put it to work in their personal portfolios. If we own something, we will try to remember to disclose that. Please do your own homework, and we trust you to make your own decisions about anything that might make sense. If you have any questions or suggestions for future topics, or if you'd like copies of these slides, those are our 2 email addresses at the bottom there, and let us know. Let us know what's on your mind. Just real quickly, here's our brief look at the condition of the market, again, as measured by the Value Line Index, which is an equal weighted index of 1,700 stocks as denoted by the green bars here. And you can see that there has been a little bit of recovery. That green bar on the far right is basically approaching that long-term trend line, that blue line. And anytime that it's in that zone, most stocks, you're going to find most stocks to be fairly valued. So the Value Line median appreciation projection does check in at 50%. When you annualize that, you get something in the neighborhood of a 10% return. So we basically say that the average stock is pretty fairly valued. That doesn't mean that there aren't some opportunities out there, but pretty much right down the middle at 10%. When you take a look at the universe of coverage that we have, our median projected return is down closer to 9%, and the proof, which corresponds along with that, is at 9.5%. So 9 to 10% for the average stock out there, just as a frame of reference as you're thinking about any particular stock. Any questions or comments, Matt?
I'll say the company's screen on the research is getting a little short. It's definitely more challenging. I'm more not in a mood to sell. There's nothing that scares me, but it seems like there are more crops that are coming to harvest time or coming to maturity than there are new seeds to plant.
Absolutely. In fact, I have a couple. You had mentioned that you had closed out a couple of positions. I am still holding my Western Alliance, but I do believe I have rolled over into the long-term capital gains zone. So, and it's in a traditional brokerage account. So we'll be taking a look at that also. All right, just wanted to bring everybody up to speed on a couple of subtle changes that many of you have been wanting for a long time. So have I, more than you, and I get to see these numbers continuously. But we have taken the projected return on value and added it to the company report page. So again, it's right down below the current price, and the point that we're going to spend a few moments with here. This is that number should compare pretty favorably. It's not going to always be right on, but should compare pretty favorably to the projected annual return. That has been our experience. That is what the statistical analysis supports. So it's just something for you to be aware of. We think it's a pretty good check and balance on that can be checked in on during any stock study. So we're kind of happy about that. The other thing Kurt did is he made it so we could subdue that nasty legend, which was coming in here and blocking this area of the chart. So if your screen doesn't look like this, if you click on that question mark, it'll actually subdue the legend and allow you to see the complete chronicle, which is something that many of us have been wishing for a while. So that cleans up things considerably. So thank you, Kurt. All right. So I thought one of the other things I wanted to point out is you can search. You can use the prove as a search criteria. So just to demonstrate a really quick run through this stuff, I just said show me some quality companies greater than 90 for their quality ranking. So top 10%. I was looking for proves greater than 12%. And then I wanted to limit it to companies with a growth rate higher than 12. Again, just for the purposes of demonstration. What I'd like you to notice is the prove column is actually displayed in the search results. And for the most part, starting at the top of the page and comparing the numbers second from the right to the par number on the far right, those numbers are what I would consider to be basically the same number until you get down the page a ways. So that's what we mean by the par will generally resemble the prove and vice versa in most cases. We're going to talk about a couple of those exceptions right here. You get farther down the page, you see this XPEL, which is a company that's been recently covered during one of our panel sessions. And then we also want to talk about one of Matt's favorites, Green Brick Partners. The fact that this prove is 28 versus 12 for the par. And that is a condition that runs rampant through the home builders, the residential construction industry. And so I want to just kind of spend a few moments thinking about what might be going on there. I think we have come up with what is happening. Any other comments here, Matt?
And I'm trying to find it. I can't find Kurt's comments. Didn't he say there were two special types of stock screens that wouldn't show proof that we are running out of columns for? I forget which conditions those were, just so people don't think it's an error.
Okay, yeah, that is an area that we do run into very prime real estate considerations. So you had to leave it off of a couple of them. I don't remember, but I looked at it. Did you find it?
As long as you don't 52-week or RSI removes fields so they fit.
Yeah. Anytime those are fields that are injected specifically for a specific search. So what he's got to do is sub one out for the other to make room for it. So yeah, the difference distance from the 52-week low is one of those. What was the other one, Matt?
RSI.
RSI, yeah. And we are working actively on the RSI to get that more current. Right now, it's just recent RSI. We want to get it more current. So let's go ahead and talk about this XPEL. It's a company that Susie, we'll come back and summarize this in a minute. A company that Susie Artsberger presented at the recent session. Ken has also included it in our best small companies list. And what I want to show you here is basically a little bit of a reconciliation. This is, we're basically looking to line these two numbers up within reason. And if you go back and take a look at the XPEL on this chart, you see a PE of 24 and a par of 26. Okay. As we look over the database, in fact, you can see some information on the right with respect to this specific company. If this number is basically brought to include what I would refer to as an implied PE ratio and basically included that with all the other ways that we look at the projected PE ratio, you see a bit of tempering. It goes from 24 down to 21, and that relatively small. And I think any of us, as we're debating a PE for XPEL, would be comfortable anywhere in the low 20s. So this 21 makes sense. That drops the par down to 20 and places it within striking distance of this 15.3. So that's the type of reconciliation that Ken likes to use as he thinks through his stock studies. When he sees a projected return on value that is, several percentage points different than the projected return, the first culprit that we will generally kind of drag on the carpet is that projected PE ratio, because it's in one half of the calculation, not in the other. So you can make that type of a judgment. Again, it kind of tempers the situation. Does that make sense, Matt, or not?
That does to me. We do have a hand raised. Ann Manning has raised her hand.
Okay.
Hey, Ann. You are unmuted.
Okay, can you hear me?
Yeah.
How's one of our favorite damsels this afternoon?
Okay. So my question is, uh, between the prove and the projected return,
Hmm.
that is a range that you think that it will be in, the return.
Yeah, what we find is we look down the list, just like we're displaying here, and the vast majority of them, 80 or 90% of them, are going to end up, let's pick a number, within 5 percentage points of each other.
Okay.
Anytime it gets, Ken uses, he says, 30 or 40% on a absolute basis. I actually just think of it more in terms of plus or minus 5 percentage points. So anytime it gets outside that, I start scratching my head. So in the case of XPEL, this 26 minus 17, that's a 9 percentage point difference. And so I'm going to scratch my head and say, okay, well, that just really needs to be audited and dragged across the coals and come to a better understanding what might be going on here. When you look at XPEL on this image, again, I think it's completely natural to be floating somewhere closer to 20 than 25 or 30 when it comes to a PE. So it's just a
Yeah,
way of tempering.
in this case, I'm kind of thinking, and we haven't looked at the other factors, but looking at projected PE being higher, of course, is one of the factors of the triple play. So
Right.
I'd say it's a good company in the fact that if it was fairly valued, it has a good return, it has a good prove, right? It has a good return on equity, but you might have a juiced return if you believe the PE, because that's what drives the par higher.
Exactly.
And we'll,
Okay,
and we'll see in the green brick is kind of the opposite way.
Mm-hmm.
so in this example, so then are you thinking that the lowest par would be 15.3?
Or yeah, or let's say I would want to see that number between, within 5 percentage points of it. So the lowest for me would be 10.
Okay.
If it was less than 10, I would be making adjustments in the other direction. I'd be thinking, something could be amiss here. Again, dig deeper to see, is the growth right? Is perhaps the profitability, the projected operating margin can be a culprit, but again, the first usual suspect in every single one of these we look at is the PE ratio.
So more than likely, if it's too high of a par, it's because the PE is too high.
Correct. Exactly.
Okay. Okay.
All
All right.
right.
Thanks.
So we're going to see the opposite situation with Green Brick Partners, because you've got a PE of 8. And again, the difference here is 12 for the par, 28 for the PE. So we're talking about a 16-point difference between the two. That merits at least 2 question marks, right? All right. So as you begin to dig a little bit deeper into what's going on with Green Brick Partners, the first thing we discovered as we started looking at all of the residential construction or the home builders is that most of them had slightly inflated projected operating margins. So that was driving the proofs higher. So we're going in and adjusting that based on value line and the sources that we use. And then coming back to this one, this is a tough one, because I really believe that the home builders are probably headed back, as is shown right here, to something like this in general, most of them. A PE of 10 to 12 historically for the average home builder has not been unreasonable. And most of them are sitting down around 6, 7, or 8 right now. So
It's certainly far below the market, right? I mean, so
yeah,
the home builders have two wins at their back. They have a generational change where we've been underbuilding homes since the Great Recession. And in fact, if you go back that far, look where we are. Even in the fevered building pace of now, we're only actually in 2021 we slightly went over the long-term average, like long-term back to World War II average, not even population adjusted. So we had a deep hole. We've only just stopped digging, much less filling back in. And then, of course, with the higher interest rates and the freeze in the existing home market, they have another shorter term win. But what makes this, and I think this PE chart is really good to look at. So ignore 2017 and before. That was Green Brick as a startup, right? So it has kind of crazy things, right? Green Brick is in Green Brick specifically, home builders in general are not going to get to a market PE, a PE of 15 or 20. That doesn't happen. These are cyclical companies, and eventually they'll come back around. But the funny thing about cyclicals is everybody knows it. So when they have their best years, their PE is lower. People are sort of tempering their expectations because bad times will come.
And
you can see that. I mean, the lowest bars here are 2020 through 2022, right? When there were feeding frenzies for houses and all this stuff was going on, and interest rates were low. That's that's optimal conditions, and that's the lowest PE they get. PEs went back up. Now results are still great, and for Green Brick in particular, they're still setting records, but the expectations are somewhat moderated. And so again, for the cyclicals, things are never quite as bad as you think they are because they'll get better again later on. So you have this PE result or expectation, which is kind of opposite earnings at that time and tempers both.
So our task is to basically moderate this, and again, using that implied PE ratio from the prove as one of the inputs. I think we're going to get to a point where we do basically moderate and temper some of the volatility in some of these PE ratios. So between that and correcting for, again, the operating margins for many of these companies were up here. The reality is this is probably a better number. If you look at your current value line page, and now these two numbers here are definitely, as we would hope, within striking distance of each other.
And very believable for an excellent operator in an industry with definite, medium term and long term tailwinds at its back. Should be around there.
Right. So again, it comes down to this notion that Ken has pointed out a few times. And trust me, you guys can't imagine how many miles we spent driving around talking about this on our ways to engagements or whatever. What is fascinating about the projected return on value is the fact that it uses so fewer variables or parameters, and they actually are the ones that have less volatility or less, let me call it, vulnerability to being chaotic, if you want to think of it that way. So again, you're talking about, we were just chatting about this before we came online, how the analysts seem to be, and journalists seem to be messing up the earnings reports as they come out. They don't mess up the sales. It's really tough for an analyst or journalist to mess up the sales. And so that one is pretty much cast in concrete. If you can lay a decent sales growth expectation here, 8 to 10%, that's a fairly solid number that we can all sink our teeth into. Again, the top line of a stock study or a stock selection guide. And then you basically scale that by their operating margin, their historical operating margin, which is a lot less volatile than the net margins or the earnings. So it's less volatile, less vulnerable. And then you toss in these numbers, which are just basically lookups, and that number is pretty solid. So it becomes a real nice check and balance on the par. So that's, again, coming back to this slide, this is the definition. Projected operating income. Again, it's a function of the trailing sales, the sales growth, and the operating margin for the company. And you divide that by the enterprise value. Again, market cap is simply the stock price times the number of shares outstanding. Total liabilities, that is where we and Greenblatt differed. He uses total debt here. We use total liabilities, and we found that basically removed in an almost heart-stopping way the amount of volatility and confusion that we saw as we attempted to apply the magic formula to a bunch of stuff. It all went away when we basically said, okay, all debt, whether it's current debt or long-term debt, we're going to use that there. And then we also correct for the amount of cash in the company's wallet or checkbook. So that's what that means by comprehensive capital. You're looking at the whole picture. How much cash do they have? What are their liabilities? Be they short term or long term, and everything's in the picture. And you avoid the vulnerabilities, the confusion that can come from accounting related stuff with earnings. Keep in mind that the earnings that are reported by a company are completely a function of tax laws. And again, I'm not saying they're wrong. I'm just saying just be aware that they are subject to adjustments, and we refer to gymnastics. So we like to have these two measures to compare. All of our research suggests that this is very true. They should be within striking distance of each other, and again, so that's why we're here, and that's why we're doing it. So again, it's on your pages right there. Watch them. When you see one that's really out of line, give me some time as we propagate through these next few update batches. But I think this is going to be pretty stabilizing to a lot of the stuff that we've seen. Any other comments or questions on that, Matt?
No, comments or questions are clear.
Okay, is Nick in the audience? Nick has had lots of questions on this particular company. I don't know if he's got a microphone.
Yes, he is.
Okay, Nick, you might raise your hand if you'd like to chime in. We've exchanged a few notes, and I share his frustration and confusion. And I would guess that there's a whole lot of other investors out there that also are pretty confused and frustrated by not just this company, but a couple others that are in that same type of area. So really, what it comes down to is this company has gone from a projected return of when everything was shooting straight up back in here, the analysts were extremely optimistic, I would say exuberant, and a lot of their return forecast type characteristics went off the chart. So we ended up with PARs in the 40s and 50s, and that has tempered here of late, and as recently as last night was down around 1%. So it's gone from one extreme to the other, and the only thing I can say is that the projected return on value is not going to move around that much, just because it's more stable with less of the chaos embedded in it. But in this case, I think that again the stabilization is going to kick in a little bit here. So you can see, I mean, this is an incredible price chart. I mean, you can't even appreciate it until you look at that price chart. It's just gone nuts. It's gone up several 100% in a short amount of time. And trust me, the people that, and these are some very smart people that follow this company, they are, and this is really sugarcoating, they are really collectively confused. And what do I mean by that? I mean, when I was reading this snippet of investment analyst coverage, I thought that the Susquehanna entry had to be perhaps an edit that they missed and didn't take out as they were using some old text. It's not. I mean, you have any people expecting, again, this is a company that's currently trading for $830 a share. Susquehanna just raised the target to 285. So as far as I know, Matt, they're not a short selling organization. This is really quite a range.
And think that 1,000 is an average, right? So
yeah.
So he's winning the tug of war, so to speak. But we all know averages are can be deceiving when you have either a lot of data or a wide range of data.
So obviously this is a red hot company. It's an interesting company. It's basically a contract manufacturer that got caught in a situation where they were probably well supplied with stuff that other people were having supply chain problems with. and their relationships with NVIDIA, and I think they have relationships with Taiwan. Um, right, right amount of resources, personnel, and equipment and commodities at exactly the right time, and that is what happened. As far as that par approaching those very low numbers, I want you to notice that fairly recently, a couple of times, the company has gone into what is considered a potentially overbought condition. Again, suggesting that low digit return forecasts, perhaps even negative return forecasts, are not inappropriate, and not there's a lot of feasibility there. So this is a wild ride, and they've been all over the place. They've been all over the place within the last 4 to 6 weeks. So here's a look at the company, some of the other parameters that I think are probably more telling. Again, the net margin is always going to be more volatile and lower down the food chain. If you believe that they're going to stay here, that should probably affect your stock study. This is basically depicting a little bit of a return back towards these other levels. I don't know. It depends on how you do your study, what you discover, and what you think. Are they going to stay closer to 10, or are they going to retreat back to more normal operating ranges for this company, and specifically around 5? And that's a big difference. The difference of 5 to 10% for operating margin going forward, I would say it's virtually unpredictable. And that's why you see that wide scatter on the previous slide. So a little more information on the company. Did find it interesting that one of the largest shareholders are these guys. Know nothing about them, so looked it up. This is actually a traditional mutual fund, ticker's DGIFX, and nothing terribly special. They have a 11.4% return over the last 10 years versus a market at 11.8, so they're actually slightly negative on the relative return. Thought I had a picture of that, but I don't. So a good average actively managed mutual fund that has that as their it is their largest position at 12% of assets. So super microcomputer. Anything else you'd like to add, Matt?
Clearly, clearly the management of this company has been relishing the implication that they're involved in AI, right? AI picks and shovels kind of a thing.
Right.
You see in the analyst comments, it's NVIDIA servers are delivering. So I think anyone considering this company, given the wide range of valuations, really needs to understand what their relationship is with NVIDIA. I would suspect some of that operating margin is they're probably buying chips at some sort of long-term rate as opposed to spot market rate, which is, anyone looking to buy a video card understands how expensive that is.
Mm-hmm.
And how many years do they have on that? There are a number of other things, like on the supply side, that was always a concern for OLED, right? They supplied to Samsung, and you had to watch like a hawk if Samsung, if the contract was getting to the deadline and what Samsung was going to do, were they going to move to something else or not? This is kind of the other side where NVIDIA is supplying the input, but you really need to understand, NVIDIA obviously holds the cards in terms of where they're going to send their chips to, and they have options.
And I'm pretty sure that Apple spent some time talking today about getting involved in their own NVIDIA-like chip.
Yeah.
So obviously there's opportunity there, and obviously competitive threat type potential also. All right. So let's go ahead and talk Groundhog for a second. I almost made the list thanks to the recent run-up in our Ardelyx, but I'm still not on there. Ken did check in at 40th. We do continue to see a number of very interesting and frequent visitors to the top of the list by a number of the bolded entries, which are investment clubs. And here's a little secret for all of you. Keith Tubbs is actually first and second on this list because he's actually a partner in Four Corners. And his portfolio is different than Four Corners, and they're both doing very well. So maybe we should be getting our hot stock tips from Four Corners.
New guest night opportunities.
Could be good stuff there. Kim is back in the top 5. Matt, I don't see your name here yet, so
No. Well, let's see how Luminar does.
is that earnings call tonight
Yes.
after market close today then?
Yeah.
All right. So again, many former champions on here and within striking distance, so they're always dangerous. Good, clean fun. Things have been really bolstering over the last couple of weeks, including last week. Now up to almost a 5% average return. And Kathy continues to languish, and the monkey is relatively safe, down closer in my position. So here we're going to go into a few moments with Berkshire Hathaway. Hopefully we don't run along too long, but Berkshire Hathaway, when you take a look at the long-term performance, this would have been slightly after Charlie was officially on the team. I mean, he knew Buffett since the 50s, but actually only formally joined in, I believe, the late 70s. But this is definitely the Charlie Munger era, and that's a pretty good track record, 18.9 with a relative return of 8.5 percentage points over that time frame. So let's talk about these guys a little bit. For years, Buffett opened his annual report by talking about the gain in book value per share. And you definitely see 2 eras on here, a breakpoint in there of some sort. That's basically a 10% change over the next several decades. And there's certainly nothing wrong with that.
Yeah, if that's mega cap growth, I'll take it.
Yeah, and I found it interesting. I had not picked up on this, but they always used to report basically the change in book value since the early 1960s. And then 5 years ago, they reported book value and market value of the stock price. And the current one is stock price only. So they've actually shifted away from this, which we used to lean on pretty heavily. But the two compare pretty well side by side. And good, clean fun. Now, you can see that's a pretty good trend over.
I don't know what the book value of Apple is. It probably doesn't do them any good. With all the buybacks, it could be negative.
Could be. So here's a look at that. Here's a look at the price over time versus the earnings. In this case, as expressed as net income. You can see that, with Geico and with the reinsurance and the property and casualty content of this company, you're going to have some of these. You just don't know when. You just know that they're going to happen. He talked about that on Saturday. But in general, outstanding performance over the long term, without question. Here's where it does get a little bit hairier, and maybe this is something to do with the challenges of being such a behemoth. And I was remarking to Matt before we got started, I had not looked at in any great depth the Berkshire Hathaway annual letter to shareholders for a few years, and I don't know if there's anything that they're not part of anymore, from housing to electricity to just about anything. I mean, even with BYD in China, they're in the EV stuff. Ice cream, whatever you can think of. And there has been a gentle tempering, especially when you stand back and close one eye, and a gentle tempering of the return on equity over time. All right, so here's a look at the PE ratio over time. Again, that top picture is a PE ratio, the prices over the earnings. And you can see that also has been fairly steady, especially for a company like this. They truly have become a conglomerate in every sense of the word that happens to have a big insurance component.
I think you left off power generation, right? That's where Greg Abel came out of.
Yep.
Significant, not transmission and separate units and power generation too.
Huge. Of course, they own their own railroad also. So, like I said,
why not? You have a bunch of power plants.
they're in everything. They literally are in everything. So here, I found this chart to be fascinating. I don't know if was this in the deck that I had sent to you, Matt. This is astounding.
Oh yes, yep.
For those of you that aren't familiar with hedge fund fees, a lot of times they will charge you a percentage per year and then a variable percentage based on the performance of the fund, and it can run several percentage points.
Yeah, 2 and 20.
2 and 20 is what it's referred to, and this is just staggering to me. First of all, that orange or yellow line comparing to the S&P 500 is again, for most people, that's not such a bad thing to have $300,000 when you start with a thousand. But again, offered the alternative of having 42.5 million. That's pretty cool. But the impact of those hedge fund type fees, is massive. I mean, you basically would have been giving 37 million back, which is it's almost unfathomable. And I hope Jason Zweig has a food tester and protective equipment at his office at the Wall Street Journal, because there's got to be some hedge fund people that are not too happy about this article. This came out.
So that's what Jack Bogle was all about. Is all about the fees.
Yeah.
Whether it's 1% seems small, but if you're earning 10% a year, that's 10% of your fees, right? That's a pretty high tip. and hedge funds are even more so.
It's just amazing when you think about handing 37 million back from a $42 million nest egg. Of course,
and they never have a down year. That's the other part too. It's even worse when you have 2022 happen and they still get paid.
Yeah. And the article actually points out that there's only a couple or a handful of funds that actually zero out their fees in a down market.
So Kay Light mentions she saw the article and mentioned it to some younger visitors to Omaha this weekend. So someone was there in person.
Yeah, I've heard from a few people that were there. In fact, I think we're going to hear from one tomorrow morning, Matt, at the heart of Illinois. All right, so here's that question we've asked a few times. I just thought we would air it out one more time. During the meeting on Saturday, Berkshire Hathaway did disclose that they had reduced their position in Apple from 174,000 at the end of the year. I believe they knocked it down to 130 or 140 billion. Did I say thousand? That's billion. 174 down to approximately 140 billion. So they have taken a little bit off the top. They have reduced their position size, but I don't know. This is something that we've always wrestled with, and I think putting it in this context makes it even more interesting. Now, Apple is 50% of this equity portfolio. These are companies that they don't own the entire shooting match. So in addition to that, they have these operating businesses like Burlington Northern and the ice cream company and See's Candy and all those that are not going to be listed in a portfolio like this, and then their entire insurance operating business. So again, anytime you look at the situation to give it full context, how much does Apple represent of the whole asset base? And it's still pretty high. It's 16% of total assets when you factor in all that other stuff. Go ahead,
It's high enough that Tim Cook was also in Omaha, right? That's what we do when we consider our portfolio evaluations and how much concentration we're willing to take. There's a little bit of a difference that Tim Cook doesn't show up to talk to us.
True.
Or at least me. I won't presume for you or Ken, at least for me.
Well, I go back to Buffett did not call me when they bought Clayton Homes. And I was very public at the time about it when I was in my days as one of the editors at Better Investing. And I still think that Buffett owes us another $1 per share for Clayton Homes. But you know what? He's never returned those phone calls, amazingly enough. So again, when you have a position in your personal portfolios at home, is 26% of your total situation too high? I think it is. And I do think you want to be watching for opportunities to whittle and trim. And Buffett did also mention that they had sold, in fact, this position down in Paramount, they sold the entire position. So they had a fairly significant tax loss in Paramount. And he hinted that the Apple transaction was related to that also, probably just doing some evening up.
Makes sense. Because the other thing is they don't need to raise more cash either, right? It's another thing to say they're preparing for something big or whatever, but they have 140, 170 billion in cash. So it wasn't to raise money either.
Yeah, he speculated that within days of the annual meeting, they were going to hit 200 billion in their checkbook. So I mean that's wild stuff. Another source that I like to go to as you watch the stuff, I find these guys to be pretty quick. This one, by the way, one of Kim Butcher's favorite sources, this dataroma.com. If you've not played with it, it is a lot of fun. This dataroma.com, and you can pull up portfolios like this for many of what they call the masters. And this is also similar situation, same information, only, like I say, this one tends to update pretty quickly. Insider Monkey, this is free. The stuff that you're seeing here is free, but it also just points out that situation as of the end of 2023, that Apple was an extremely dominant position in this portfolio. And again, if you're in an investment club in this situation, celebrate and then be vigilant for opportunities to trim would be my advice. I'm not saying Apple's a bad company. If you've got NVIDIA and it's way up there also, again, these are not bad companies, but it can make sense on a prudent scale to trim the size of those positions from time to time. You don't need to get carried away, but you just want to be vigilant and take advantage of those opportunities. They own 6% of Apple.
Yep, and as Buffett likes to say, that $110 billion buyback will increase their percentage ownership.
Yeah, Apple will be spending some of their own cash on themselves. Here's a look at Apple again, not by any stretch of the imagination a run for the hills moment. I would consider it a strong hold in general. But if you do get a situation where, again, a big price run up is what led to that very low return forecast there, it's actually at that price right there. Sometimes that can make sense to do some trimming. Here's a look at Berkshire Hathaway, and with some of those considerations that are in there, again, a 10% type growth rate, projected return on equity in the 4 or 5% range. There's certainly nothing wrong here, but I would say this is a little bit of a weaker hold, and I know that's blasphemy on the heels of the worship weekend, but
well, and when cash is earning 5%, right? That's what we're saying. Think about it.
And this one here troubles me a little bit too. So between that projected PE ratio and the return on equity over time, it would just give me a little bit of heartburn if it was a large portion of one of my portfolios. Again, I recognize fully I'm going against the religion, but this is a reality, everybody. They've become such a massive conglomerate, blend of businesses that, I mean, that is the situation. They went into some fairly significant detail about challenges that they face at Geico. And I've talked to a number of friends in the insurance business that can definitely relate to that challenge that they have. They also have a challenge, as Matt said, they own 4 or 5 major Western utilities, starting with the one in Des Moines and going all the way out to the Pacific Ocean. And they are faced with some of those challenges from the wildfires and some fairly significant challenges and potential costs and damages to their business. So that is there, and it is a reality. And then last but not least, and enlightening will strike me as I disclose this, but a few years ago I wrote a paper for the Mutual Club of Detroit where I laid out in fairly careful analysis what happens when Jack Welch is gone. And the Jack Welch premium was, GE was trading at 30 when it probably deserved to trade at a price to earnings ratio of 15. That's kind of true here too. And
it'll happen. Hopefully, God help us, it won't be for a while, but it was in the retrospective too, where Charlie said very famously, I'm almost dead. I think you all can handle a little inflation.
Absolutely. And Buffett, he was as open and conversant about the transfer of leadership at the company as he has been in years. He did hope to be back next year, and we certainly hope that also. But the cold-hearted reality of it is, without him involved, I would not be the least bit surprised to see the PE cut nearly in half. And that's based on, and you guys can all go out and do your own studies. If you take a look at true conglomerates and look at the type of PE ratios that are involved, much like Matt was talking earlier about the PE ratios at the home builders. When you start stacking in the property and casualty insurance component, which typically has a PE around 10, and then include some of the more commodity-ish businesses, and that entire mix, you basically get to a 12 to 14, maybe 15 PE ratio for the mix being actually admirable. And they're not there right now. In fact, what's it at right now? It's at 24. So if Mr. Buffett were to retire one way or the other, it's a risk that needs to be considered as a shareholder of the company.
I mean, selling doesn't have to be to death do you part either, right? This would be exactly the kind of company. It isn't that, return on equity is definitely leveled off. It isn't deteriorated. The price is high. It's done well. So if you did come to that decision, put it on the watch list. Just wait for the next March 2020 or March 2009 and strike when everything's on sale.
All right. So with that, we did want to talk briefly about this. We've got a couple minutes here, Matt. This was not talked about this weekend, but something nudged me. This is with respect to the overall stock market, and it's Buffett's own. He actually coined this several years ago, where he takes the total value of U.S. stocks, divides by the gross domestic product, and comes up with this ratio. And it's basically operating at levels suggesting that things are pretty pricey. And
I think this was the link you had shared earlier, Mark, just to address my first complaint. And I looked at this before, but looking at it again, right? Obviously, when you look at GDP and you think of, although this is total stock market value, but think of S&P, right? How much of that business is outside the U.S. So there's maybe a decreasing correlation between U.S. GDP and what our listed companies have, and that's represented by the incline dashed line, right? It's not a constant line comparing 1960 to 2020, somewhat like going back to your slide on the value line or any other thing. There is a trend, and there is a increasing set of expectations, and we're still quite a bit above even that point.
Yeah, a lot of the income and contributions from non-U.S. companies in the numerator is what Matt's talking about, to pump that number up over time, and that's actually become pretty significant. So here's another way to look at that same information, again compared to that trend line basically, and looking at the statistical amount of volatility. This is a moment that's worth noting. I mean, when the NASDAQ hit the levels back in March 2000, it took quite a while to get back. And the entire decade that followed here is what Ken lovingly refers to. It's actually not love, it's a love-hate relationship. The lost decade did follow that. So it's something to be mindful of. Again, if you have family members who are near their life expectancy, have enough money, need to protect assets, maybe you do cover yourself a little bit. Again, no reason to panic, but if you're in a situation where you can't afford to lose 30 or 40% and do that wild shopping spree that Matt was just talking about, that Buffett often says he hopes to live long enough to see another 2009. I gulp every time I say that, but he said it. Yeah, during those type of excursions, it can get quite ugly. So just something to think about. And here's a chart that I do like to check in on. It's the number of companies making new highs versus new lows. And again, the episodes that happened back in 2008 with that moment in history, here's COVID, which amazingly was even worse in terms of companies making new lows. And then what we went through a couple of years ago. And right now, the average is actually in a fairly decent direction or at a decent level. So again, no need to panic. But again, if you're a person that needs to do capital preservation, or if you know somebody in your family, it could make sense to basically follow Buffett's lead. He bragged several times about the number of times they have a whole boatload of money in 5% treasury bills. So he's following his own advice there for sure on behalf of Berkshire Hathaway. All right. Anything else? Just a quick look at the Buttonwood portfolio. Did you want to add anything to that, Matt?
No, I have a couple things at the end coming back
Okay.
around. Finish up.
All right. We will be finishing this out with another 3 or 4 companies here over the next few weeks. And it's tough to tie Ken down. He likes all kinds of companies. So just trying to get him to limit the field a bit. But we will be doing that. And
Natural diversifier.
he is. Just a reminder that we do archive all of these presentations on YouTube under Manifest Investing, so you can go back and check. We had a lot of fun with the St. Louis chapter just a few days ago with that roundtable, and learned a lot about Air Products and how much you guys like Air Products, the company. Here's our reminder that with the issue 2 updates for in this next value line batch, we will have updates in on all of the consulting companies and consulting related companies. We will be diving into that. And then here's a moment from the video, several moments from the video leading up to the Berkshire annual meeting. CNBC always puts together this montage of stuff. And I had no idea that they had messed around with the Breaking Bad crew. And this is Buffett actually conspiring to corner the peanut brittle market. And just a whole lot of fun with the Breaking Bad gang up at the top. Lower left is Susan Lucci taking over the Berkshire meeting a few years ago. And Charlie didn't argue with her a bit. He actually exclaimed that she had certain wonderful attributes that Buffett does not have. And then she proceeded to go into an announcement that they were initiating dividends. And Charlie actually agreed with Susan. So interesting moment. And then last but not least, I did not know this either. The desperate housewives have a crush on or had a crush on Charlie. So just some interesting moments from the meeting and very well done. Links to the actual CNBC version of this. It's video. It's entertaining. Are available on this week's update, and then I also posted it on Nick's thread on Charlie's tribute on the homepage. What else did you have, Matt?
Just a couple things from the questions line. Steve Emmerich shared that NPR did a profile of the Beardstown ladies just last week. I did share that to everyone, so you can check the questions queue for that link. Cheryl Smith gave a nod looking at the groundhogs to all the women in the top 15. Not surprising at all.
Okay.
And then a question going back to the discussion of prove, and I think you did touch on this. Daryl Boltman asks, in a previous time, did you use net income instead of operating income?
That's where we started because that's what it's definitely related to what Greenblatt has done. So yes, so we probably do have a version out there from our very earliest explorations with something other than operating income. So yes, you're not imagining things. Like I said, we started with long-term debt and it gave us a headache.
Yep.
And the total liabilities completely blew away the headaches.
That's what I always, in all this kind of work, I keep in mind the quote from George Box that says, "All models are wrong, some are useful." So keep it simple, keep it, explore those anomalies, just like you laid out here. Very good. Maybe they disprove your theory and you have to throw it away, but maybe you find a way to either make it better or understand what's going on and how useful your tool is. That's all. That's how you sharpen your knives, how you keep your tools in shape.
Yeah, and in fact, we didn't talk about it here today, but we actually use a slightly different version for the asset-based companies. We basically substitute book value for the liabilities minus cash, and the reason for that is when it comes to banks and asset-based businesses, the cash and liabilities get rather tangled and chaotic and confusing, and switching to that do pretty well. Greenblatt's answer to that was to not include the asset-based companies in the magic formula, along with cutting off any of the small caps and micro caps, and we obviously couldn't tolerate that either. So that's how we ended up where we ended up.
Yep. So we're at time, and that clears the questions.
Okay. All right. Well, thanks everybody, and good hunting out there. Thanks, Matt, for helping out. And we will not have a session next week because Ken and I will be packing for Chicago. We'll return 2 weeks from today. And everybody remember that Mother's Day is approaching and deal with that accordingly. So take care, everybody.
Bye, everyone.